You pay your premium every month. You think of it as a promise, a guarantee, a safety net stretched beneath your family, waiting for the day you might need it. But here's the question almost nobody asks. While that money sits with your insurer, what is it actually doing? Increasingly, the answer isn't sitting safely in reserve. The answer is, it's on Wall Street. Over the past decade, a wave of private equity firms has moved into an industry that used to be almost boring by design. Life insurance and annuities. Boring was the point. Insurers held your premiums in conservative, highly regulated reserves, invested in safe, liquid assets so that when a claim came due, the money was there. Private equity works differently. Its entire business model is built on using other people's capital to chase higher returns, often through complex, illiquid, and hard-to-value investments. So when these firms started buying insurers, they weren't just acquiring a company. They were acquiring access to a massive, steady pool of premium dollars, money that could be redirected into their broader investment strategies. Regulatory filings and industry data tracked by insurance commissioners show this shift is not a fringe phenomenon. It's a structural change in where a growing share of American retirement and life insurance premiums actually live. Let's make this concrete, because systemic risk can sound abstract until it has a name attached. Consider the case of PHL Variable Insurance Company, a life insurer based in Connecticut. For years, families paid premiums into PHL policies the way millions of Americans do. Quietly, faithfully, assuming the math was being handled responsibly on the other end. After nearly a decade under private equity ownership, PHL's finances deteriorated to the point that state regulators stepped in. What they found was a shortfall of roughly $2.2 billion, a gap between what the company owed policyholders and what it actually had on hand. Connecticut's insurance regulator froze roughly $400 million in payments to avoid what amounted to a run on the company. Policyholders, people who had paid premiums for a decade or more, expecting a guaranteed payout, were told their benefits would be capped, in some cases at a quarter or a third of what they were owed. One family story, reported by Bloomberg, captured the human cost precisely. A couple had paid life insurance premiums for 17 years, expecting a $2 million payout to protect their children's future if tragedy struck. When the policyholder died, his widow received $300,000 and no clear timeline for the rest. This is what happens when a safety net gets treated as a financing vehicle instead of a promise. So how does this actually work? When a private equity firm acquires or partners with an insurer, it often restructures how the company invests its reserves. Instead of conservative bonds and liquid assets, premium dollars get funneled toward the kinds of investments private equity firms specialize in. Private credit, structured products, real estate, and other illiquid assets that can take years to convert back into cash. For the private equity firm, this is an efficient source of long-term, relatively patient capital. Life insurance liabilities are paid out over decades, so insurers are, in effect, a source of permanent capital. Money that doesn't need to be returned to investors on a fund's usual 5 to 7 year timeline. For the policyholder, though, this creates a mismatch. Your policy promises a fixed, guaranteed benefit, but the money backing that promise is now tied up in investments that can lose value, get frozen, or simply take too long to liquidate when a wave of claims comes due at once. Regulators are aware of the risk. State insurance departments have increased scrutiny of these ownership structures, but oversight varies significantly from state to state, and the complexity of modern reinsurance arrangements, where risk gets passed between multiple related entities, sometimes offshore, can make it genuinely difficult for regulators to see the full picture in real time. PHL Variable is one case. It is not, by most accounts, an isolated one. The volume of life insurance premiums and annuity assets now under private equity-linked ownership has grown substantially over the past decade, according to data tracked by industry regulators. Some of the largest insurers in the country have entered similar arrangements, restructuring how they invest policyholder funds. This doesn't mean every private equity-owned insurer is on the brink of collapse. Many are managed conservatively and meet their obligations without issue. But the structural incentive is worth sitting with. The further premium dollars drift from safe, liquid, transparent reserves. And toward complex, high-yield investment strategies, the more the safety in a safety net depends on the ongoing performance of financial markets and on the judgment of firms whose primary obligation is to their investors, not to policyholders. That's a quiet but significant shift in who a life insurance company is actually working for. It's worth stepping back to notice the pattern here because it echoes something the financial system has seen before. For decades, there was a clear line between institutions that carried a public safety net, banks with government-backed deposit insurance, and institutions that took on market risk without that backstop, like investment banks and hedge funds. That separation existed precisely because mixing the two creates a hazard when risk-taking is cushioned by a safety net. The incentive to take bigger risks grows because the downside is softened. Insurance is now facing its own version of that question. Life insurance and annuities exist because people want a guarantee, something explicitly outside the ups and downs of the market. When the underlying premium dollars get invested the way a hedge fund invests, that guarantee becomes only as strong as the portfolio behind it. None of this means walking away from insurance altogether. It means asking better questions before you sign. Who owns your insurer? And has that ownership changed recently? State insurance department websites typically disclose this, and a change in ownership is public information. What is the insurer's financial strength rating? And has it moved? Rating agencies track exactly this kind of risk. And if you already hold a policy with an insurer that's been acquired by a private equity firm, it's worth understanding how your state's guarantee association works, the backstop that exists if an insurer becomes insolvent, and what its coverage limits actually are because they are often lower than people assume. The promise of insurance has always been simple: pay in a little, steadily, so that when the worst happens, the money is there. That promise depends entirely on where the money goes in between. Increasingly, for a growing share of American families, the answer is Wall Street. Not a vault, not a conservative bond ladder, but a portfolio built to chase returns for someone else. Your premium was supposed to fund your safety net. Ask who it's actually funding now.